In 1719, France believed it had discovered unlimited wealth. A royal-backed company promised gold from Louisiana. Paper money flowed into the economy. Share prices surged across Paris. Aristocrats invested. Merchants invested. Ordinary citizens invested. This was presented as national recovery. Instead, it became one of history's earliest large-scale financial scams. When confidence collapsed, fortunes vanished, riots broke out, and France entered economic crisis. This was the Mississippi Bubble. When Louis XIV died in 1715, France faced a severe financial imbalance. Decades of warfare had expanded the national debt to unprecedented levels. The War of the Spanish Succession alone had drained enormous resources. By 1715, French state debt was estimated at nearly 3 billion livres. Annual revenues were insufficient to service interest obligations. Tax collection was inefficient and fragmented. Regional privileges limited uniform fiscal enforcement. Confidence in the monarchy's finances weakened. Coin shortages restricted commercial activity. Specie flowed unevenly through the economy. Trade slowed in several provincial regions. Credit markets were constrained by limited liquidity. The Regency government under Philippe II, Duke of Orleans, inherited this instability. Reform was necessary to prevent fiscal paralysis. France required a mechanism to restructure debt and expand liquidity. Traditional taxation could not resolve the burden quickly. Default risk threatened state credibility. Public frustration with stagnant economic conditions increased. Merchants demanded monetary flexibility. Aristocratic creditors sought repayment certainty. The financial system lacked centralized coordination. Metallic currency limited monetary expansion. Economic recovery required innovation beyond conventional policy. It was within this environment that John Law proposed reform. Law argued that money was a tool of circulation rather than intrinsic value. He believed expanding paper currency could stimulate trade. He also believed debt could be reorganized into productive enterprise. These ideas appealed to the regent's need for rapid stabilization. France's vulnerability was structural rather than temporary. Debt concentration, restricted liquidity, and declining confidence combined. The political leadership sought controlled experimentation. Desperation lowered resistance to unconventional solutions. Reform was framed as modernization. Stability required restoring trust in state finance. The monarchy's backing would provide legitimacy. Institutional endorsement would reduce perceived risk. Financial recovery became intertwined with state authority. The conditions for large-scale speculation were forming. High debt created urgency. Urgency created openness. Openness allowed financial experimentation to scale rapidly. John Law was not a conventional French financier. He was a Scottish economist and gambler, born in 1671. Law believed that money derived value from circulation rather than metal content. He argued that expanding credit would stimulate commerce and increase national wealth. His theories had been rejected in several European states. France's fiscal crisis created opportunity for experimentation. In 1716, with approval from the regent, Law founded the Banque Générale in Paris. The bank was privately organized but operated with political backing. It accepted deposits in coin. In exchange, it issued paper notes payable to the bearer. These notes were redeemable in specie on demand. The innovation was not paper money itself, which had precedence. The scale and institutional endorsement were new. Banknotes simplified transactions. They reduced the need to transport heavy coin. They increased the velocity of circulation. Confidence grew as notes were accepted in commercial exchange. In 1717, the bank gained additional privileges. In 1718, it was transformed into the Banque Royale. Royal conversion meant the bank's notes were guaranteed by the crown. This state backing enhanced legitimacy. Paper currency began to expand more rapidly. Law argued that increased liquidity would revive trade and tax revenue. Credit conditions eased. Merchants gained access to capital previously constrained by coin scarcity. Specie gradually flowed into the bank as deposits. Paper notes flowed outward into the economy. The supply of money increased beyond metallic reserves. The regents supported the expansion as a path to fiscal stabilization. Public perception equated royal backing with security. The bank's notes traded at par with coin during early expansion. Trust in paper began to replace exclusive reliance on metal. Law's system tied monetary reform to broader state restructuring. Debt conversion and credit expansion were linked. Institutional credibility strengthened the experiment. Economic activity appeared to accelerate. Short-term stability reinforced confidence. The financial foundation of the Mississippi Company was forming. Monetary expansion created capacity for speculative investment. State endorsement reduced perceived risk. The mechanism that would fuel the bubble was now operational.
In 1717, John Law expanded beyond banking into colonial enterprise. He acquired control of the Compagnie d'Occident. This company held exclusive trading rights in the French territory of Louisiana. Louisiana was vast in geographic scale. Its economic output was minimal. The region lacked developed infrastructure. Population levels were low. Yet it was presented as a land of extraordinary potential. Promotional materials emphasized gold, silver, and fertile land. The Mississippi River was described as a commercial artery. Investors were told that colonial expansion would rival Spanish success in the Americas. The company's monopoly structure increased its appeal. It controlled trade, resource extraction, and territorial administration. Monopoly rights reduced competition risk on paper. In 1719, the company absorbed additional trading monopolies. It merged with the Compagnie des Indes Orientales. It consolidated African and Asian trading privileges. The structure expanded into a comprehensive imperial enterprise. Law linked this company directly to state debt restructuring. Holders of French government debt were offered conversion into company shares. This transformed illiquid bonds into tradable equity. Debt was converted into speculation. The monarchy supported the arrangement. Royal backing implied national endorsement. State creditors were incentivized to participate. The company promised dividends funded by colonial trade. Share subscriptions increased rapidly. By mid-1719, confidence intensified. Debt previously viewed as burden became opportunity. The merger between bank and company operations deepened integration. Paper money issued by the Banque Royale financed share purchases. Liquidity fueled equity demand. The value of shares became intertwined with monetary expansion. Colonial narrative justified valuation increases. The promise of American wealth replaced scrutiny of current revenue. State endorsement reinforced optimism. The Mississippi Company became both a trading monopoly and a debt management tool. Its success depended on sustained confidence. Its valuation depended on projected colonial wealth. Speculation was now institutionalized. Debt conversion had transformed fiscal crisis into market enthusiasm. By early 1719, Mississippi Company shares began rising rapidly. Initial share prices had been issued at 500 livres. Demand quickly exceeded supply. Speculators resold shares at significant premiums. By mid-1719, prices doubled. By late 1719, shares approached 5,000 livres. The increase was driven by expectation rather than revenue. Dividends had not yet materialized at projected levels. Street trading intensified in Paris. Rue Quincampoix became the center of speculation. Crowds gathered daily to buy and resell shares. Nobility participated alongside merchants and professionals. Servants and laborers entered the market indirectly. Paper fortunes were created in weeks.
Newly wealthy investors purchased property and luxury goods. Credit expanded in parallel with share demand. Loans were secured against rising equity values. Paper currency issued by the Banque Royale increased further. Monetary expansion supported share inflation. The relationship between banknotes and equity tightened. Rising share prices reinforced trust in paper money. Trust in paper money supported further share purchases. The cycle became self-reinforcing. Royal endorsement strengthened confidence. The regent publicly supported the system. John Law was appointed Comptroller General of Finances in early 2020. His elevation further legitimized the structure. Foreign investors began participating. Speculative enthusiasm spread beyond Paris. The company's valuation became symbolic of national recovery. State debt appeared to shrink as shares rose. Paper wealth replaced fiscal anxiety. Social mobility narratives emerged. Fortunes were displayed openly. Consumption signaled confidence. Risk assessment declined. Few questioned the sustainability of price levels. Liquidity masked structural imbalance. Share demand depended on continued monetary issuance. Valuation exceeded realistic colonial profitability. Speculation had reached a systemic scale. The Mississippi Company was no longer merely a trading enterprise. It had become the centerpiece of French financial reform. Its price reflected belief rather than earnings. The mania phase was fully established. By late 1719, paper money had become the primary fuel of speculation. Shares of the Mississippi Company were increasingly purchased with banknotes rather than coin. The Banque Royale expanded issuance to meet subscription demand. New tranches of shares were financed directly through newly printed notes. Monetary expansion accelerated alongside equity valuation. The money supply in France grew far beyond metallic reserves. Specie coverage declined relative to outstanding paper claims. As more notes circulated, consumer prices began to rise. Inflationary pressure appeared in urban markets. Luxury goods increased in price first. Property values in Paris appreciated rapidly. Rents rose in neighborhoods near trading centers. The apparent wealth effect stimulated additional consumption. Share subscriptions were sometimes financed through short-term credit. Investors pledged existing shares as collateral for new purchases. Leverage entered the system implicitly. The line between currency and equity blurred. Banknotes were issued against state debt and company shares. Shares rose in price because banknotes were abundant. Banknotes retained value because shares continued rising. This circular reinforcement strengthened the illusion of stability. Official reports emphasized colonial potential rather than current returns. Louisiana's actual output remained limited. Gold discoveries were rumored but unverified. Population growth in the colony was modest. Infrastructure development lagged behind projections. Revenue streams did not justify market capitalization, yet valuation continued expanding. The market priced future abundance rather than present income. Royal authority maintained formal backing of the system. Confidence depended on the belief that notes were convertible. Convertibility depended on sufficient specie reserves. Specie reserves were proportionally declining. Public trust remained strong during peak expansion. Speculation spread beyond financial elites. Small investors purchased fractional positions. Some individuals sold property to acquire shares. Paper certificates replaced tangible assets in portfolios. Accounting values diverged from physical reality. Price stability depended on continuous inflow of new capital. Monetary issuance postponed structural imbalance. The economy appeared vibrant. Underlying liquidity risk increased. The system required sustained confidence to function. Paper wealth substituted for productive output. Illusion intensified as prices climbed. The financial architecture rested on expanding circulation. If confidence faltered, the structure would contract rapidly. The separation between valuation and colonial fundamentals had widened decisively. The valuation of the Mississippi Company depended heavily on colonial imagination. Louisiana was presented as a territory rich in gold and silver. Pamphlets described fertile soil and unlimited agricultural output. Illustrations depicted prosperous settlements along the Mississippi River. Promotional narratives compared French prospects to Spanish-American wealth. In reality, Louisiana remained underdeveloped. The colony's European population was small. Infrastructure was limited to scattered trading posts. Agricultural productivity was inconsistent. Transportation networks were primitive. Mining output was negligible. Trade revenues were modest. Company publications emphasized potential rather than present performance. Speculative maps exaggerated territorial value. Reports of mineral discoveries circulated widely. Many were unverified or fabricated. Colonial expansion plans were described as imminent. Settlers were encouraged to migrate with promises of prosperity. Ship departures from French ports were publicized as signs of growth. The scale of migration did not match the narrative. Conditions in the colony were harsh. Disease and logistical shortages were common. Supply chains struggled to support distant settlements. Yet in Paris, confidence remained elevated. Investors rarely examined colonial reports critically. Few had direct knowledge of American conditions. Distance allowed myth to replace measurement. State endorsement reinforced the narrative. Official silence on negative reports reduced skepticism. The company's monopoly status implied guaranteed profitability. Projected revenue streams were treated as inevitable. Speculation relied on belief in future extraction. Colonial wealth became symbolic capital. Imagination amplified valuation. Share prices reflected expectation of abundance. The disconnect between Paris and Louisiana widened. Market enthusiasm overshadowed logistical constraint. Banknotes continued circulating to support subscriptions. Monetary expansion postponed confrontation with reality. Information asymmetry protected optimism. Profitability was assumed rather than demonstrated. The company's earnings remained secondary to its promise. The myth of colonial gold supported financial inflation. Narrative replaced fundamentals. The illusion of limitless wealth persisted. As long as belief held, valuation remained elevated. The fragility of the system remained concealed. Confidence depended on sustained imagination. The colony did not generate the wealth implied by its price. The structure required faith to remain intact. By early 1720, the balance between paper and specie began to shift. Investors who had accumulated large paper fortunes sought conversion into gold and silver. The Banque Royale was legally obligated to redeem notes on demand. Redemption requests increased steadily. Specie reserves were limited relative to circulating paper. Large withdrawals strained the bank's capacity. John Law attempted to slow conversion. Limits were introduced on the amount of specie redeemable per person. Confidence weakened as restrictions expanded. The public interpreted limits as evidence of imbalance. Share prices began to fluctuate. Volatility replaced steady ascent. Law responded by adjusting the official share price. Administrative price controls replaced market discovery. The state attempted to cap both share value and currency exchange. In February 1720, measures were introduced to reduce the price of shares gradually. The intention was to deflate the bubble in a controlled manner. The reaction was immediate. Investors interpreted price adjustments as confirmation of overvaluation. More holders rushed to liquidate positions. Demand for specie intensified. Queues formed outside the bank. Tensions rose in Paris. Confidence eroded quickly once convertibility appeared uncertain. The circular structure between notes and shares began to unwind. Falling share prices reduced collateral value. Reduced collateral value increased pressure on the bank. In March and April 1720, additional decrees attempted stabilization. Limits were placed on the holding of precious metals. Conversion between paper and coin was restricted further. These measures were intended to preserve liquidity. Instead, they amplified distrust. Speculators attempted to move wealth discreetly. Capital flight pressures emerged. Street disorder became more common near trading centers. Rumors circulated faster than official statements. The state's credibility became directly tied to the bank's solvency. Paper currency lost purchasing power. Share prices declined sharply from their peak. Wealth that had appeared stable proved temporary. The liquidity crisis was not merely financial, it was psychological. Trust in redemption determined system survival. Once doubt dominated, contraction accelerated. By mid-1720, the mechanism that had fueled expansion operated in reverse. Monetary contraction reinforced share decline. Share decline reinforced monetary contraction. The collapse mechanism was fully engaged.
By mid-2020, the Mississippi system entered rapid decline. Administrative controls failed to restore confidence. Share prices fell, despite official interventions. Attempts to manage valuation undermined credibility further. Investors no longer trusted the announced price levels. Secondary market trading accelerated downward. Panic replaced structured speculation. Queues outside the Banque Royale grew longer. Redemption requests exceeded manageable capacity. Specie reserves were visibly insufficient. Rumors spread throughout Paris. Confidence deteriorated quickly once fear became collective. Share prices collapsed from their peak near 10,000 livres. Values fell to a fraction of previous highs. Paper fortunes disappeared within months. Collateral supporting loans evaporated. Credit relationships broke down. Merchants faced sudden liquidity shortages. Street disorder increased near Rue Quincampoix. Crowds protested outside financial offices. Isolated riots erupted in Paris. The government deployed guards to restore order. Conversion between notes and coin was further restricted. Currency manipulation failed to stabilize purchasing power. Paper money depreciated sharply. Inflation combined with collapsing equity values. The middle class absorbed heavy losses. Aristocratic investors also saw significant reductions in wealth. Some individuals were financially ruined. Luxury consumption slowed abruptly. Property values corrected downward. Bankruptcies increased. Trust in John Law's system collapsed. Law's authority weakened rapidly. Foreign investors withdrew confidence. Speculative enthusiasm turned into suspicion. The Mississippi Company's valuation continued falling. Debt conversion gains reversed. The monarchy's financial credibility was damaged. Public anger targeted both the bank and the company. The experiment in large-scale paper finance ended abruptly. By late 2020, the share price stabilized at much lower levels. The speculative peak proved unsustainable. The integrated structure of bank, company, and state unraveled. Liquidity contraction reinforced price decline. Price decline reinforced liquidity contraction. The crash was not gradual. It was accelerated by the collapse of trust. The wealth created during 1719 proved temporary. The financial shock reshaped French attitudes toward innovation. The bubble had fully burst. As the collapse intensified in 1720, the French state intervened directly. John Law's authority deteriorated rapidly. Public anger increasingly focused on his role in the system.
In May 1720, Law was removed from his position as Comptroller General of Finances. His influence over monetary policy diminished. Attempts were made to restructure the Banque Royale. Currency regulations were revised repeatedly within months. The government attempted to stabilize paper notes by decree. Mandatory exchange rates between notes and coin were imposed. Limits on specie holdings were introduced. Private possession of large quantities of gold was restricted. These controls were intended to prevent capital flight. They signaled institutional weakness. Confidence continued to decline. Law proposed additional monetary adjustments. The regent's support weakened under political pressure. In late 1720, Law fled France. He departed quietly to avoid escalating unrest. The Mississippi Company remained operational but diminished. Share values stabilized at far lower levels. Debt conversion gains were largely erased. The government reorganized outstanding obligations. Efforts were made to reduce the circulating money supply. Paper notes were gradually withdrawn. Specie re-entered circulation slowly. The integration between bank and company was dismantled. Administrative separation replaced unified control. Royal endorsement was moderated in public discourse. Officials sought to restore credibility. The monarchy avoided formal default. Instead, it absorbed reputational damage. Legal accountability for speculative promotion remained limited. Few prosecutions followed the crisis. Political stability was prioritized over punitive measures. Financial controls became more conservative. State experimentation with large-scale paper issuance ended abruptly. The memory of instability lingered among investors. Public trust in monetary innovation deteriorated. The Mississippi experiment concluded with institutional retrenchment. State backing had amplified expansion. State intervention could not reverse collapse. The system required confidence to function. Once confidence broke, policy tools were limited. The royal-backed financial structure had failed. The damage required years to repair.
The collapse of the Mississippi bubble reshaped French financial culture. Trust in paper money declined sharply after 1720. Many investors equated notes with instability rather than convenience. The memory of rapid inflation persisted. Merchants returned to preference for metallic currency. Specie regained symbolic authority. Credit conditions tightened across the economy. Lending standards became more conservative. Risk tolerance decreased in Paris financial circles. The state avoided large-scale paper issuance for decades. Innovation in monetary policy slowed. Financial experimentation was viewed with suspicion. The monarchy's credibility suffered reputational damage. Confidence in royal financial endorsement weakened. Foreign investors approached French debt cautiously. Interest rates on state borrowing reflected increased risk perception. Debt restructuring remained necessary but politically sensitive. The integration of bank and state was reconsidered. Future financial reforms were incremental rather than transformative. Institutional caution became embedded in policy discussions. The Mississippi collapse influenced debates on public credit. French elites remained wary of speculative expansion. Economic growth resumed gradually but without comparable exuberance. Colonial ventures continued but with tempered expectations. The episode reinforced the importance of convertibility. Liquidity management became central to fiscal planning. The dangers of overexpansion were acknowledged privately. Public discourse emphasized stability over rapid enrichment. Speculation did not disappear entirely. However, participation became more selective. The social memory of loss influenced investment behavior. Paper wealth was treated with skepticism. The connection between state endorsement and financial security weakened. Policymakers recognized limits of administrative price control. The circular relationship between currency and equity was studied cautiously. Future crises in other nations would echo similar patterns. The Mississippi bubble became a reference point in European financial thought. Economic historians later analyzed its mechanisms in detail. At the time, its lesson was practical. Confidence could not be mandated by decree. Monetary expansion without proportional backing invited instability. State sponsorship amplified scale but also risk. The integration of debt conversion and equity speculation proved volatile. France's recovery required time and restraint. The bubble's aftershock extended beyond immediate losses. Financial innovation slowed. Institutional memory hardened. The episode demonstrated the fragility of trust-based systems. The economic consequences endured beyond 1720. The Mississippi bubble established a structural template for modern financial crises. Its foundation began with sovereign debt pressure. The French state required restructuring without formal default. John Law offered monetary expansion as solution. Paper currency increased liquidity rapidly. Liquidity stimulated asset demand. Asset demand elevated share prices. Rising prices reinforced confidence. Confidence attracted broader public participation. Monopoly privilege strengthened perceived security. Exclusive colonial rights implied guaranteed revenue. Royal endorsement reduced perceived risk. Debt conversion transformed government liabilities into speculative equity. Speculation appeared aligned with national recovery. Monetary issuance and equity appreciation became interdependent. As long as prices rose, stability appeared intact. The system required continued confidence to function. Confidence depended on convertibility into specie. Specie reserves were finite. Paper claims were expandable. Once redemption demand increased, imbalance surfaced. Administrative price controls failed to restore trust. Restrictions signaled weakness rather than strength. Liquidity contraction reversed prior expansion. Falling asset values exposed leverage. Leverage accelerated decline. Public belief shifted abruptly. State authority could not compel confidence. Narrative could not replace reserves. The monopoly promise masked weak fundamentals. Colonial wealth had been projected rather than realized. Speculative cycles amplified political endorsement. State sponsorship magnified participation. Participation magnified systemic exposure. The bubble did not collapse because of one event. It collapsed because belief reversed. Reversal transformed expansion into contraction. The integration of banking, debt, and equity concentrated risk. Future financial systems would replicate similar patterns. Central banks would expand liquidity during crisis. Governments would endorse strategic enterprises. Investors would equate policy support with safety. The Mississippi episode demonstrated the limits of that assumption. Technology changes. Currency evolves. Financial instruments become more complex, but the structure of speculative excess remains constant. State endorsement, monopoly promise, credit expansion, public enthusiasm, collapse when confidence breaks. The pattern endures beyond 1920.